Good day, family. Welcome back to this video, and this your mentor and your coach, Mr. Pleasr. So, guys, as you've seen the title of this video, we are doing higher time frame versus lower time frame. So, guys, I've went through this, and this is actually institutional trading, because when you go into retail trading, it is possible. I know a bit of traders who do get almost the same risk ratio as the same as institutional traders, but actually they are retail traders, but they do that only on the 1 minute time frame. But let's just focus on this video, guys. So I'm just gonna make a breakdown of EURJPY just from the day one time frame to the lower time frame, and I want to show you something. I want to show you something powerful, and I want to show you why I love to use the 1 minute time frame and the opportunities that lie into the 1 minute time frame, and how much I can actually secure from the 1 minute time frame, how it has an advantage to uh, our trading plan and giving us a good risk ratio. So let's just start from our day one time frame on EURJPY, where we are just going to make a very first breakdown. So over here we're just going to place our daily highs and our daily lows. We're just going to place our daily highs and our daily lows, guys. So we can see this is our daily high, then our daily low, it's over here. Yeah, it's over here, guys. It's over here. This is our daily low and our daily high. So let's just jump into the H4 time frame. So we can see that the market is on a bullish momentum. EURJPY is on a bullish momentum. Let's just adjust this point over here. Perfect. So now let's just look for H4 highs and H4 lows. So we can see the H4 low over here. There's the H4 low. Oh, wait a minute. Okay, there's the H4 low, guys. This is the H4 low, and we would have said this is the H4 high, but yet the structure, it has already broken the structure. So also the H4 high is this level. So let's just go to our H1 time frame. So on our H1 time frame, we're looking for our H1 low. So we can see that this is our low. No level has broken that level. H1 low. Perfect, guys, perfect. So we are now getting deeper into the analysis. We can see that the market has been creating higher lows, higher high, higher lows, higher high, and I can see over here that the market has given us what, an equal high, So we'll just place our equal high over here. And guys, I want to show you something that you did not know. So if I can remove this part, It's just that I don't have the paid I haven't like activated my paid account on TradingView. But if I can remove this part, okay, if I can remove this part, I would have shown it. So let's first place this. I want to show you also the advantages of trading institutionally, guys. I'll show you the advantages of trading institutionally. Okay, uh, equal high. So basically, guys, we have what we call liquidity. We have what we call liquidity. So basically, liquidity it lies where mostly retail stop losses are. So as you can see over here, guys, this is our support, this is our resistance. Just forget doing this cashier. Guys, I'm back. So as you can see over here, as I'm telling you guys, that we have our resistance lying over here, we have our support lying over here, then we have our resistance lying over here. Okay, so retail trading, it says you sell at resistance, then you buy at support. So okay, the market goes up, it is our it is the resistance point. Okay, you place your sell, it comes back over here, saying that maybe you took your profits, okay, or maybe you didn't take your profit and you see the market shifting up. So you telling yourself that this is just a retest, then it is a good move. Or most retail traders, they just wait for the second confirmation, then the retail traders take their trades over here, then the stop losses lies over a bit over here, the stop losses lies over a bit here, then the take profit is over here. So this is retail trading basically. This is retail trading. But look at what happens. Look at what happens. The market goes down. It gives them a bit of confidence. But see, the market just broke down. You know what's happening over there? It's because the market. It's because let's just fix this a bit so that okay. It's because liquidity lies over here. Liquidity lies over here. So liquidity on if we can experience equal highs, liquidity lies above equal highs, then on equal lows liquidity lies below equal lows. So basically liquidity lays here, so liquidity wants to be free, so it will break the structure so that it may be free. Then high possibilities that it might come down again and break the lower ones. So this is actually liquidity. This is actually liquidity. I've just covered it in a short version, but I'll be making a video of what is liquidity in full. So as you can see, the market just broke the structure and went up. And over here, guys, as you can see, it gave us a point of interest. The market gave us a point of interest over here. Then this one candle retested the point of interest. But in small time frames, you might find that the market went up and then came in retest. Okay, this is what I'm talking about. You can see the market went up and came in retesting this candle. Then at least you should have taken your trade from here to, till up there. So if you're an institutional trader, at least you would have seen it. But by even not seeing this confirmation, you know that when equal highs comes out, the market wants to free this liquidity, because we have liquidity lying over here. So guys, okay, as you can see, we have a clearer vision now of the equal high and the breakout. So the market broke out. So now let's just look at this part. Let's just look at this part. So we can clearly see over here that we have another equal high, and also liquidity has been freed over here. Okay, you'll be able to see it very well. So this is I'm getting into detail of what I was speaking about. You'll just see. Just uh, stay tuned. Pay attention to what I'm doing. Okay. So this is our equal high. So retail traders. Okay. This is our resistance. This is our support. Market goes down a bit. Retail second time. Retail traders take the trade over here, and they think the market will come over here, will come and trigger itself down again. But market actually what? Break structure, freeze what? The liquidity. Then the market gets down. So as the market gets down, we can clearly see again that we have some equal lows. I can clearly see that we have some equal lows over here. We have some equal lows. It will be seen very well on the smaller time frames. So we have equal lows, equal lows. So we have equal lows. So we know that under this, under our support level, this is our support level, equal lows. We know that there must be a bit of liquidity over here lying. There must be liquidity lying over here. So, and we can clearly see from this point that there was a bit of a point of interest. As you can see, yes, there was a point of interest. Because smart money concept says a point of interest or an OB, it's a saying in a situation like this, of a sell situation. So basically we state or we place an OB when we see a bullish candle. Then after a bullish candle, there is a bearish impulsive move. But yet also the next candle must be engulfed by the previous candle. So over here you can see that it was not engulfed. So we take this one, we now take this one to be our OB candle. So basically meaning, as you can see, after an OB must be mitigated, guys. An OB must be mitigated. So, but also for to see that your OB it's valid, to see that your OB is valid and your OB is much more stronger, you have to see a bit of inefficiency, or a bit of inefficiency, in other words is imbalance. And we can clearly see an imbalance over here. So we can see that your JPY, it is a powerful trade to take, and I'm going to take it next week. Monday I'm taking this trade. Over here, guys, we can see that we have inefficiency. We can see that we clearly have an inefficiency, which is what we call also an imbalance. Meaning on this blue area, because you know what is imbalance, guys. I'm going to make a clear video of everything, separating it all. But just for a summary, there must be a 50% buyers and also 50% sellers on the market. So you can see clearly from this blue area, there were only buyers, and there were no at least 50% or a bit of a percent of sellers onto it. So there were only buyers onto this area. So this is inefficiency. Sellers were not able to participate into this part. And again, mostly we do not take trades based on only the imbalance. It's tested and it doesn't work at all times. So, but we place our OBs, and our OBs become stronger by seeing an imbalance closer to it. So we had an OB and we had our imbalance. So we're expecting the trade to come at least to this point and shoot up. So but let's just get into more details. Let's just get to more details. So if you can look at this very well, we want to see over here, because mostly after the break of this after the market is free its liquidity, we have what we call an FU candle. We have what we call an FU candle. So we can see over here that we had a bit of a point of interest, but it was not engulfed by this one, but this one was engulfed by this one. So it means we place this one as our what? As our point of interest. So in lower time frame, we can see them move very well, but this is what I'm trying to show you today. This is what I'm trying to implement to you, that why I take trades on 1 minute time frame and not on a higher a bit of higher time frames. So as you can see, the market gave me an FE candle. Obviously, after the break of equal highs, I'm looking at a bit of an FE candle, and after the mitigation of an FE candle, I'm looking to take my trade because it's a beautiful setup for me and it allows me to do so. So we can see that over here we had our trade. So I would have placed this trade over here, my stop loss being over here. I want to show you the difference now. My stop loss over here on M15 time frame, it's 8.4 stop loss, which is a bit big when trading institutional. Then my take profit being over here 60 pips. Okay, it's good, but we're looking at what my risk ratio. My risk ratio is 1:7. It's 1:7. Then again, what confirms this EURJPY trade is, let's now jump into retail trading. It's just a very fast one. We can clearly see that we have a bit of a continuation channel and a very clear and beautiful one continuation channel on EURJPY, guys. So let's just move that one out of the way a bit, so that we can be able to draw our channel. What's going on? Guys, take time to watch your charts. Take time to watch your chart. Take time and let also the chart teach you. So as you can see, guys, we have a very beautiful confirmation that the market is still going to go down. Then we have equal lows that we know that the market has to free the liquidity that is lying over here. And after the market has freed this liquidity, the market can't just turn. There must be something that is going to make it turn. So I know many of y'all are looking at this OB, are looking at this point of interest, but I don't think this point of interest can also hold. But I just have much comfort. I just have a lot of confidence into the market coming to this point, and not this one, not supporting this one. This one might also work, but I'm not into it. I'm just not into it. I don't have much comfortability onto knowing that the market is just going to come there, because I know that if the market can come here, it's retesting also this area. It's retesting this area, and this area now becomes our support. This area now becomes our support. Then we can take our buy trade, and it's we taking the trade upwards. So okay, guys, let's just focus on the real deal, on why I say I take a higher time frames versus lower time frames, and why I love lower time frames. So you can see we are securing 1:7 risk ratio with a 8.4 stop loss. And the reason of us taking the trade over here, and you can see it's in profit, it's because of this FU candle, guys. It's because of an FU candle and the break. Let's just jump into M5 time frame. We're just going to have a clear view. We just going to have a clear view of everything right now. Okay, guys, we can basically see over here with the market, we have this candle again, but we're going to focus on this one. So now our new FU candle is this one. On M5, our M5 FU candle is going to be this one. Let's just draw it. So change our color. So now guys, our FU candle is going to be that one. So the trade was very close to hitting our stop loss, but it didn't. So let's just see the stop loss of M5 time frame. I love taking M1 time frames, guys. M1 trades. So we'll just adjust this one to this level, and our stop loss being over here. Our stop loss being just over here. So our stop loss over here is 5 is to 5. Then our take profit being over here, same take profit. So okay, now on M5 time frame, we are securing 1:11 risk ratio on with a 5.5 pip stop loss. On M15 time frame, we are only securing 1:7 risk ratio with a 8.4 stop loss. Let's just go to my favorite time frame. So we are now on the M1 time frame. Let's just delete that for a moment. So we're just going to focus on this on our M1 time frame right now. So we can see on our M1 time frame, guys, that we had a bit of market going up, market wanted to give us a bit of so the market over here just gave us our OB. Okay, so market came. So this can be regarded this one, or this one can be regarded this one. But let's just take this one because we had a bullish candle over there, which might be causing some sort of stuff. So let's just require this one. Let's just see. Yeah, it's perfect. Okay. So you can see, guys, let's just take our trade. So we're going to take our trade from there, our stop loss being over here. So now our stop loss has decreased to 2.3 stop loss pips, to 2.3 pips stop loss. Okay, is our interest there. Then our take profit is over here. Oh, wait a minute. Then our take profit is over here. Let's just go to the top. Then now our risk ratio is 1:30. 1:30. This is the tricks that I've been using, guys. This is how I be making a lot of risk ratio. This is how I be taking high risk ratio trades. M1 time frame is the king for me, guys. This is the key time frame, guys. This is the key time frame for me, guys. This is how higher time frame versus lower time frame. You will be able to make more on the lower time frame than you can make more on the higher time frame. I know it can be on an argue, but I'm speaking about trades like this, which you have seen the pure breakout, and I haven't cheated anything. It's just that the thing about it is that you might be confused. I know you might be confused. On the M15 candle, on the M15 time frame, we had an FU candle. Inside that FU candle, there were other FU candles. So it's just when we go to smaller time frame, it's just that it's showing us where mostly the importance of the FU candle, where is it laying inside that FU candle. So when we go down to our 1 hour time frame, as you can see, this is the one candle, guys. This is the one FU candle. This is the one FU candle over here. One M15 FU candle. But if you can look properly, the most important part of the FU candle is this part. So by you lowering yourself to the 1 minute time frame, you'll be able to know where it lies. You'll be able to know where it lies, and you'll be able to have a better risk ratio. As you can see, we have a 2.2 pip stop loss and a 1:30. A 1:30 risk ratio, guys. This is it, guys. This is just it for me, guys. I hope you can see how well it works. I hope you can just see how well it works. Then we can also like capitalize on this one. I want to show you more about the liquidity on other videos, but let me just show you some bit of a trick over here. As you can see, we had a beautiful trade over here. We had a beautiful equal high over here that I didn't see. Just saw it right now. I wanted to show you that even when this trade is still running, we can have many other trades. We can have many other trades. It's just that you have to manage your risk very well, and you must know which trades you must take. Be very careful what the trades you take. You must know that there must be high probability trades. Okay, guys, so we had an equal high over here. We had an equal high over here. Then what? Liquidity was free. Liquidity was free. Then the market came again down to this level. So we might be expecting that the market over here, we have it. Over here we have. So I'm expecting this from the market now. If you miss the trade, guys, if you missed other trades, if maybe you want to take the buy, because over here we have I'm expecting the market to just I'm just expecting the market to come. Why is this holding me back? But no problem, guys, no problem. I'm expecting the market to come to this level, mitigate it, and then we can take our trade. We can take our trade over here. If only the market can come and mitigate that level, we can take our trade with a 1.8 pip stop loss. Okay. Yes. 1.6 pip stop loss to our take profit level, guys. To our take profit level. We can take it to our take profit level. Our take profit level is over here, guys. It's over here. Let's see how much risk ratio is it. It's 28. 1:28, guys. You cannot miss this setup. This is 1:28 risk ratio. 1:28 with this beautiful setups, beautiful trades. Guys, this is institutional trading, guys. Lower time frame, guys. This is what I be killing on. This is what I be making money on, guys. You better invest your time onto this. You better know the right things to do, guys. Please. So it is your boy once again, Mr. Paul SA. I hope this was not a long video because there was a lot of knowledge shared with you guys, a very powerful knowledge about institutional trading, and I hope you had a clear vision of how I actually trade. And I also see something here that I actually missed. We can see over here that we had a point of interest. Oh, I missed this beautiful trade over here. This is just some scalp trade that we take, knowing that at least we must pass this level. I know that my take profit must be over actually this level at most times. So I would have taken my trade over here, which this is our point of interest. This was mitigated. At least I will take profit over here. Yes. And we know our risk with a 0.8 pip stop loss, guys. 0.8 pip stop loss, guys. Like, guys, I hope you can see, guys. 0.8 pip stop loss. This is a 1:5 risk ratio trade. A very neat trade that we just like I've just seen right now, guys. Right now. These are trades that we take. These are trades that we take. Clean charts. That's what we'll be working with. Clean charts. Guys, I'm signing out. I'm signing out, guys. I'm signing out. It is your boy once again. Please don't forget to hit the subscribe button. Please give this video a thumbs up. And don't forget to turn on the notification button. And it is your boy once again, Mr. Pleasr. I'm signing out. Yes, sure.